The tax gap years, what to do between retirement and Social Security. There's a window in retirement that many people either don't know exists or don't know how to effectively use. It sits between the day you stop working and the day you start Social Security. Now, for many people, that can be somewhere between 3 and 8 years. And during that window, your taxable income is often lower than has been in decades, maybe lower than it will ever be again. What you do with that window determines a significant portion of your lifetime tax bill. By the way, subscribe if you want more content like this. I focus specifically on planning decisions that make the biggest difference in the 10 years before and after retirement. So let me explain why this window is so important. During your working years, every dollar you earned was income. You were in whatever bracket your salary put you in. However, in retirement, if you've structured things thoughtfully, you can have substantial assets and still have relatively low taxable income in a given year. Social Security, once it starts, adds to your taxable income. And because of how Social Security taxation rules work, a portion of those benefits become taxable once your combined income from different sources starts crossing certain thresholds. Now, at age 73, required minimum distributions from your traditional IRA or 401k begin, adding an additional forced taxable income stream whether or not you need the money. The gap between retirement and the start of both of those income sources is your opportunity. It's the window where Roth conversions are the cheapest. It's where your tax bracket is the lowest and where you can do work that would reduce your tax burden for the next 20 or 30 years. Now, here's what that looks like in practice. If you take a 64-year-old who retires with $1.6 million in a traditional IRA and plans to delay Social Security at age 70, and between 64 and 70, that's where they have the 6 years where their taxable income might consist of primarily whatever they draw from savings or maybe a pension. If they draw $60,000 from savings and have a small pension, let's say of $15,000, their taxable income before any IRA activity is $75,000. Now, as a married couple filing jointly, they are in the 22% federal tax bracket with significant room before they hit the next 24% threshold. And that means they can convert an additional $50,000 or $60,000 from their traditional IRA into a Roth, pay the tax at 22%, and get that money permanently out of the tax-deferred bucket. Now, if you do that for 6 years, you've moved somewhere between $300,000 and $360,000 out of the IRA at known moderate rates. By the time you hit age 73, the balance that becomes subject to required distributions is meaningfully smaller. The annual RMD as a result is lower, and less of your Social Security is taxable because your combined income is lower. Oh, and IRMA, which is the income-related Medicare surcharges that catch many people off guard, is less likely to trigger because your income in prior years was managed down. By the way, let me explain IRMA because it's one of the least understood pieces of this planning. IRMA, these are all certain letters, stands for Income Related Monthly Adjustment Amount. Essentially, it's the surcharge on your Medicare Part B and Part D premiums that kicks in based on your income in prior years if it crosses certain thresholds. In 2024, if your modified adjusted gross income for 2 years prior exceeded $103,000 as an individual or $206,000 as a couple, you would pay a higher Medicare premium, and that's, by the way, for both spouses. That surcharge can range from a few $100s per year to more than $5,000 per year per person at the highest income levels. And here's the thing that catches people. Your IRMA is based on your income from 2 years ago. So if you do a large Roth conversion in 2025, that's going to affect, potentially, your Medicare premiums in 2027. And that connection often gets missed. The practical consequence is that managing your income in these gap years is not just about your federal income tax picture. It's also about managing your future Medicare costs simultaneously. A $60,000 Roth conversion that keeps you under the IRMA threshold might save you $3,000 to $4,000 in Medicare premiums 2 years later, on top of what you save on income taxes in retirement in total. You see, these decisions are linked. Now, Roth conversions aren't free. You're going to pay taxes on the converted amount in the year of the conversion. The question is whether you pay at a lower rate now or potentially at a higher rate later. If your rate now is 22% and your expected rate at 73 once the RMDs start tacking on top of Social Security is 28%, well, the math strongly favors converting now. If the rates are going to be similar, there are still some benefits to a Roth. For example, the money that goes into a Roth is never subject to RMDs during your lifetime. And when you take money out, they're tax-free withdrawals. And by the way, this is also turns out to be often a better outcome for your heirs. Because under the Secure Act, non-spousal heirs, like your children, are generally required to empty this inherited IRA within 10 years. So if your children inherit a large traditional IRA during what might also be their peak earning years, meaning that they're at their highest salary, well, the additional withdrawals from that traditional IRA over 10 years could drive them up into the 32 or 37% bracket, basically giving up 32 or 30 cents on every dollar. Now, if they inherit a Roth, those withdrawals are still tax-free. By the way, there's also a Social Security timing piece that intersects directly with these gap years. The single most impactful financial decision many retirees make is when to start their Social Security. Every year you delay past age 62, your benefit grows. The growth rate, by the way, between the amount that you get at age 62 and the amount that you would get at age 70 is approximately 77% if you can delay that long. So if your benefit at 62 would be $2,000 a month, waiting to age 70 brings it roughly to $3,500 a month, plus any cost of living adjustments on that higher base, but that's for the rest of your life. And if you're married, your spouse is going to get the higher amount for the rest of their life too. Now, for people who are healthy, delaying at least to age 67 and ideally to age 70 is going to produce substantially more lifetime income, especially if they live into their 80s or beyond. But delaying Social Security also means you're going to need to fund those gap years from somewhere else. And this is where having a plan for that sequencing matters. If you draw, for example, from your taxable brokerage account, you're spending money that's already been taxed with relatively low additional tax cost. If you do moderate IRA conversions on top of that, you're going to use your low income window to clean up your tax deferred balance. And when you arrive at age 70 with your Social Security starting, you'll have a smaller IRA, a larger Roth, and a much cleaner tax picture for the rest of your retirement. The opposite path is one I see regularly with people that come in without a plan. They retire, they leave their IRA alone because they've been told to let it grow, it's tax advantage. They start Social Security early because they want that income. But then when they arrive at age 73, they've got a large tax deferred balance of full Social Security already baked in, now also taxable, and an RMD that stacks everything together, driving them into a much higher tax bracket than they expected. By the way, nothing illegal happened. Nothing catastrophic happened. They just missed an 8-year window that's never going to come back. There's a chapter from a book that I wrote on tax-smart retirement that goes through all 5 of the major tax traps in retirement in detail. RMDs, IRMA, Social Security taxation, the widow's tax penalty, and what happens to IRAs under the Secure Act. The link to download that chapter for free is in the description below. And if you're within 10 years of retirement or already in the gap years right now, it's worth reading because that window is real and it closes eventually.